The greatest enemy of a trader is not the market. It is not news. It is not manipulation as well. It is the pressure created when you risk more than you can emotionally handle. Leverage looks powerful on the surface. It promises faster profits, bigger returns, and rapid growth. But leverage also exposes every weakness in your psychology. It magnifies fear, it magnifies greed, and if not controlled properly, it destroys your judgment completely. Most traders think over leveraging only damages the account, but the truth is deeper than that. It damages the mind first of all. Your body will often warn you long before your account balance does. And if you ignore those particular warnings, the market eventually forces you to pay the price. The first sign is insomnia. The market closes, but your mind does not. You lie awake at night thinking about your position. Your body feels restless. Your mind keeps replaying scenarios. What if the market gaps down tomorrow? What if the trade fails? What if you lose everything? This is not normal trading stress. This is a warning sign that your position size is too large. Professional traders understand something very important. If a trade disturbs your peace of mind, the trade is already too big. It does not matter how confident you are in that particular analysis. It does not matter how good the setup looks. If you cannot sleep peacefully, your ability to think clearly is already compromised. And once emotions take control, decision making collapses. Fear enters in the morning. Hope enters in the afternoon. Discipline disappears completely. The market becomes emotional instead of logical. This is why experienced traders reduce their position size to what can be handled comfortably. Your real risk tolerance is not what your account can mathematically survive. It is what your mind can emotionally survive. The second sign is obsessive checking. You constantly look at the chart. You refresh prices every few minutes. Every small movement affects your mood. One candle gives relief, the next candle creates panic. At this point, you are no longer trading strategically. You are emotionally attached to every single tick. The professional trader can walk away from the screen because they trust their plan, they trust their stop loss, they trust their risk management, but the over leveraged trader cannot disconnect. They become a prisoner of the market. This obsession reveals something important. You have lost emotional distance from that particular trade. Your entire mental state depends on price movement, and that is dangerous because once your emotions become tied to every fluctuation of the market, you stop making rational decisions. Trading turns into emotional torture. The third sign is fear of normal pullbacks. Markets never move in a straight line. Healthy trades breathe. They move up, pull back, consolidate, and continue. Professional traders understand this particular rhythm. They expect temporary pullbacks as part of the process, but when your leverage is too high, even a small dip feels catastrophic. A 2% move suddenly feels emotionally unbearable because your exposure is too large. Your heart races like anything. Your confidence disappears like anything. You panic during completely normal market behavior. This is one of the clearest signs of excessive leverage. The problem is not the market movement. The problem is your vulnerability to it. When your position size is reasonable, normal volatility feels manageable. When your leverage is extreme, normal volatility feels like disaster. And because of this fear, traders exit good positions too early, only to watch the market later move in the original direction. The fourth sign is desperation. You begin feeling that you must win on this particular trade. This mindset is extremely dangerous because trading is a probability game, not a certainty game. The market does not care about your bills, your pressure, or your financial situation. It simply rewards discipline and punishes emotional decision making. The moment you emotionally need a trade to work, you lose objectivity. You stop reading the market clearly. You start seeing only what you want to see. You ignore warning signs. You hold losers too long because accepting the loss feels unbearable. You take profits too early because fear tells you not to lose what little gain you have. This desperation destroys discipline, and desperation almost always comes from over leveraging. When one trade becomes emotionally important, your size is too big. Professional traders understand that no single trade should define their financial future. One trade is just one event in a long series of probabilities. The fifth and most dangerous sign is breaking your own rules. Every successful trader survives because of discipline. Cut losses quickly, respect stop losses, never average down emotionally, manage risk consistently. These are survival principles, but leverage creates emotional pressure so intense that traders start bending their own rules. They say things like, I'll hold till longer, little longer, the market will come back, I will add more to reduce my average price. This is where account collapses. Averaging down emotionally is not the confidence, it is fear disguised as conviction. You are not adding because the opportunity improved, you are adding because you cannot emotionally accept that particular loss. That is the major difference. The moment you begin making excuses to, violate your own rules, leverage has already taken control of your psychology. And once discipline breaks, destruction usually follows quickly. These five signs are powerful warnings: insomnia, obsessive checking, fear of small pullbacks, desperation to win, breaking your own rules. They are not technical indicators on the chart, they are signals from your own mind and your own body. The market always reveals when your size is emotionally unhealthy. The problem is that most traders ignore these warnings until the damage becomes severe. Leverage itself is not evil. Used correctly, it can be a useful tool. But in the hands of an emotional trader, leverage becomes dangerous. It amplifies every weakness in a psychology. And this is why trading success is not about making the fastest money, it is about survival. The goal is to stay in the game long enough for discipline, probability, and consistency to work in your favor over time. And survival requires emotional stability. A trader with a calm mind and perceived capital can always recover from losses. But a trader who loses emotional control eventually loses everything else too. This is why position sizing matters so much. Good trading is not about maximizing profits on one trade. It is about protecting your ability to think clearly across hundreds of trades. Your mindset is a greatest asset. Once fear controls your thinking, your edge disappears completely. So learn to recognize these warning signs early. Be brutally honest with yourself. If your trade is affecting your sleep, your emotions, or your discipline, reduce the size immediately. Protect your capital, but more importantly, protect your mind. Because trading is not won by trader with the biggest position. It is won by the trader who can remain calm, disciplined, and rational under pressure. And that only happens when your risk is under control. The market will always be there tomorrow. Opportunities will be always returned. But if leverage destroys your discipline and confidence today, you may not survive long enough to take advantage of those future opportunities. So remember this clearly. The purpose of leverage is to support the opportunity, not to create emotional chaos. Real professionals understand this. They trade in a way that allows them to think clearly, sleep peacefully, and follow their rules without any hesitation. That is the real edge in the trading. Not aggression, not prediction, but emotional control under uncertainty. That is for today. I will see you in the next one. Have a nice day. Jai Shivrai.